This video covers accounting for unearned revenue. Companies sometimes receive cash from customers in advance. This is in advance of performing the service or delivering their products. The cash collected is called unearned revenue. The reason that it's unearned revenue is because, as we mentioned, the company has not yet performed services or delivered the goods. Recall that a company earns their revenue when the company performs services or delivers goods to the customer and the company's part is done. So in this case, the company has collected the cash, but they have not delivered the goods or performed any services. Unearned revenue is a liability to the company. Examples of unearned revenue include things like companies that sell airline tickets, companies that have concerts, college tuition, magazine subscriptions, and so on. Example of college tuition. If you enroll in a college, you pay for the tuition before classes start. But the college does not earn their revenue until the end of the semester when their part is done. The college has a liability to provide the students the course or to refund that tuition. If you look at an airline ticket, every time a company sells an airline ticket, they're selling for a future service. The airline company collects the money from customers, and everything that they collect is a liability to the company. The company earns their revenue when they take the customer to the correct destination. Now, as time goes by, the unearned revenue is earned when the companies perform services or deliver their goods. In some cases, the companies will recognize their revenue as it's earned, but in a lot of cases, the company does not record revenue until end of the period when they are ready to prepare their financial statements. This is true of a lot of things that expire as time passes. So if the company is providing a service, every month they provide the service, but they don't need to recognize their revenue until it's time to prepare financial statements. At the end of the period, the company will measure how much revenue they have earned and then record an adjusting entry to recognize that revenue. Let's take a look at an example. It says, Toledo Company had the following events for its first year of operations. Only selected events are shown. Toledo Company received $6,000 cash in advance for 1 year of maintenance services that will begin on September 1st, year 1. 2 says, at the end of year 1, Toledo Company recognizes the revenue earned from its maintenance contract in transaction 1, which is the adjusting entry. They want you to use a horizontal financial statements model to show how each event affects the balance sheet, income statement, and the statement of cash flows. Before we go and show how the transactions affect the financial statements, let's do a timeline and calculate the adjusting entry. Here is a timeline. So this is year 1 for the company. And it says that on September 1st, so September 1st is towards the end of the year, somewhere here, on 9/1 of year 1, the company receives $6,000 cash. And the $6,000 cash is for a 1-year maintenance contract. Now fast forward to the end of the accounting year. This is December 31st of year 1, and the company is getting ready to prepare their financial statements. So they need to figure out whether they've earned any revenue between September 1st and December 31st. Have they? Yes, they have. So we need to figure out how much revenue they've earned. First of all, let's see how many months are there between September 1st and December 31st. Use your fingers. As I said, it's very easy to make a mistake otherwise. do we include the month of September? Yes, we do, because this contract started on September 1st. If it started on September 30th, we wouldn't include September, but it started on September 1st. So we had to include September, which is 1, October 2, November 3, and December 4. So we're looking at 4 months during this period. How much revenue does this company earn per month? You can figure that out by dividing your 6,000 which they received, which was for an entire year, and dividing that by 12 months. That gives you $500 per month. Now, we can figure out how much is revenue earned for these 4 months. That's $500 times 4 months, which is a total of $2,000. The company earned $2,000 during the 4 months, so we'll need to recognize that as an adjusting entry. Let's write that 2,000 right next to number 2 so that we will remember that's the amount we need to look at. Okay, now that we've got all the calculations done, let's go and see how each of these items affect the financial statement. For the first transaction, it says Toledo Company received $6,000 cash in advance for the maintenance services. Let me put 1 here because we're looking at transaction 1. What are the items affected in the balance sheet for this transaction? We know that the company receives cash. Cash is an asset, so cash increases by $6,000. So I'll put that as a positive number here. What else happened? Now the company has a liability. They owe $6,000 worth of services to their customer. We're going to record that as an unearned revenue. And unearned revenue is a liability. So under the liabilities column, I'm going to record unearned revenue. And unearned revenue, before this transaction we didn't have any unearned revenue. Now we have $6,000. So I'll put that also as a positive number. That takes care of the balance sheet. Now let's look at the income statement. Did this transaction affect the income statement? No, it did not. We didn't have any revenues, nor did we have any expenses. So it did not affect the income statement. Unearned revenue is not a revenue, it is a liability, as we talked about a minute ago. Now let's look at the statement of cash flows. Did this affect the statement of cash flows? Cash was affected, so yes, statement of cash flows is affected. We had cash inflows of $6,000. What type of activity is this? This is for future revenue, so it's related to revenue. Revenue is an operating activity. Now let's look at item 2. Item 2 is the adjusting entry. We determined already that we had earned $2,000 off this revenue. So how does earning $2,000 affect the balance sheet? We know that our revenue has the effect of increasing retained earnings. Retained earnings is a part of stockholders' equity. So under stockholders' equity, I'm going to put retained earnings. And retained earnings is increased by revenue. So I'm going to put this 2,000 as a positive number. What else happened? Well, the company does not have a liability of $6,000 anymore. We've already earned $2,000, so we can decrease unearned revenue to show that we don't owe $2,000 of services anymore. We've already earned that. Now we've only got $4,000 remaining at the end of the year. That takes care of the balance sheet. Now let's look at the income statement. Did the adjusting entry have any effects on the income statement? Let me put 2 here, so this is relating to the second item. The income statement is affected if there's any revenue earned or expenses incurred. And we did have revenue earned in this adjusting entry. We had $2,000 of revenue earned, so we're going to increase our revenue by $2,000. Nothing happened to expenses, so which causes net income to also increase by $2,000. Does this affect the statement of cash flows? No, it does not. There is no cash whenever we look at adjusting entries, so the statement of cash flows is not affected by this adjusting entry. That's it for this video. Please let me know if you have any questions.